Good morning, everybody. Thank you and welcome to joining this morning's webinar. Today's session is now being recorded for those of you who heard the message, and it will be available later in our Investor Centre on the Novatti website. It's just turned 11 o'clock now, so I'm going to start today's webinar briefing. Thank you very much for joining us. My name is Beth Moylan, Head of Growth at Novatti, and today I'm joined with Mark Healy, CEO of Novatti. Mark's been leading Novatti's transformation into a market-led, customer-focused organisation and delivering seamless payment solutions that help businesses across Australia and New Zealand to survive and grow. We'd love and encourage you, as always, to submit questions, which we're going to address at the end of the webinar. To do that, just simply type your questions into the Q&A box at the bottom of your screen. And if we don't cover a question during the webinar, we'll make sure that we cover them directly if you email us directly at investorrelations@novatti.com, and we'll respond to you there. Over to you, Mark.
Thank you, Beth, and good morning, everybody, and thank you again for joining us. Today, I'll take you through our June quarter and then spend some time on what comes next, because the June quarter completes the financial year. FY26 was the year we completed the reset, and FY27 is the year we push forward with growth. I'd like you to take three things away from today's session. First, the turnaround is done. 4 consecutive quarters of normalised positive operating cash flow and group margin now at 50%. Second, our core Australasian payments business is growing and growing profitably. And third, we have a clear stage roadmap that positions Novatti for where payments are heading. We're building unique Australasian payments infrastructure, sitting across both the current and future payment ecosystems. Let's get started and then we'll finish with some questions. The world is changing and the digital economy is on the move. And money is changing form. Stablecoins, or regulated digital cash, and tokenised deposits are now moving real value on new payment rails. And this is no longer a crypto story. Around $390 billion USD of stablecoin commerce moved globally in 2025. And the majority of it was business to business. Closer to home, the Digital Assets Framework Act passed in April this year and brought those new rails inside Australia's regulatory perimeter. Novatti is developing a leading position into the rapidly advancing digital asset economy. Anchored by our investment in the AUDD stablecoin and the growing use cases around tokenisation, we are very well positioned for the adoption of regulated digital finance. Our view is that stablecoins are not a disruption strategy, they are an efficiency strategy. They won't replace the existing payment rails, rather becoming a complementary optimisation layer where speed, liquidity, or finality resolve friction in many areas of money movement today. Now, Australia already has instant domestic payments through the NPP, the new payments platform. So in a mature market like ours, the prize isn't necessarily speed. Rather, it's programmability, atomic settlement, and offshore reach, the flows that the NPP cannot carry. And importantly, that demand is real today, with a clear pipeline from live through to horizon use cases. This includes licensed digital asset platforms, importers, exporters and remitters, platforms and marketplaces paying gig workers and knowledge workers across borders, real-time settlement for merchants in our own acquiring book, and beyond that sit tokenised assets and agent-initiated commerce. So adoption is no longer the question, as business flows have started already crossing over. The real question is, who will businesses trust to transit both worlds? And that's where Novatti's position is genuinely hard to replicate. We are a principal member of Visa and MasterCard in both Australia and New Zealand, an AFSL holder, PCI DSS and ISO 27001 certified, We're a stored value platform for wallet and alternative payments. We hold a key position in the issuer of AUDD, Australia's leading AUD-backed stablecoin, and with an ASX listing and 30 years of history of moving money safely and securely. In short, one regulated bridge across every form of money: cards, account to account, wallets, and stablecoin. And that's the company we're building. Essentially, we're creating an interface across the traditional and digital ecosystem. And this slide shows what that bridge looks like in practice. On the traditional payments franchise, we already service many leading Australian and international companies across card issuing, merchant acquiring, Asian wallets, and cross-border payments. These are household names processing volume through our infrastructure every day. Last quarter, nearly $1 billion settled across our AUNZ payments infrastructure. On digital infrastructure, we're connected into the emerging ecosystem through our stake in AUDD's issuer and through the product work we're doing to connect our payment rails to stablecoin networks. In a rapidly changing world, new blockchain rails and programmable digital finance are innovating around the traditional rails. Looking forward, our thesis is that the real value in payments is moving from execution to decision. And future success is not just moving data or money around a single payment stream, but to provide interoperability. In other words, to determine and then orchestrate how payments get made for clients. What payment type, what identity is trusted, which rail it uses, and what system authorises the transaction. And increasingly, without a human in the loop. Why is this important? Because companies need simplicity across their payments infrastructure, not even more complexity and a spaghetti bowl of relationships as payments diversify. For shareholders, the point is this: you don't have to pick a winner between the old rails and the new. Novatti will sit across both, regulated on each side, with the traditional business funding the journey and the digital side providing the upside as the market evolves. Now to the quarter and to the statement that I open with, that the turnaround has been sustained. Here's the data. In the June quarter, we've achieved 4 consecutive quarters of normalised positive operating cash flow. Group margin 50%, whereas a year ago in the same quarter it was 26%. Group cash EBITDA of 0.3 million, up 0.4 million on the prior March quarter, and 3 million of cash available at 30 June, which doesn't include the 1.2 million from the AUDC share sale that settled in early July. It's actually worthwhile discussing the cash movement number that you'll see in the Appendix 4C today. The headline operating cash flow for the quarter was negative 1.8 million, but that was a deliberate choice. We've used the improved profitability of the business to pay down some historic liabilities and to strengthen relationships. Paying down the past is part of finishing a turnaround, not a departure from it. Strip out payments against historic liabilities and the underlying business generated 0.3 million of cash in a quarter, the 4th quarter in a row that has now been positive. I also want to acknowledge something else directly. It's obviously been a hard 12 plus months for the share price. Some of that is fintech sentiment, which we can't control. But some of it reflected very fair questions about this company. Can Novatti cut costs and still grow? And can it sustain positive cash flow? At the time, they were the right question to ask. But we now have 4 quarters of consistency and sustainability. So the rest of today is about what we do with that foundation. Under the strategic reset, our focus has been to build a sustainable business positioned around the 3 pillars of simplification, a market-led customer focus, and lifting our financial performance. Payments ANZ is where the pivot back to growth shows up first. Revenue of 3.9 million, up 8% on the March quarter. Gross margin of 1.9 million, up 26%, and cash EBITDA of 0.9 million before corporate overheads, up 95% quarter-on-quarter. In aggregate, AUNZ now generates the largest revenue, gross margin, and EBITDA within the group. And underneath all those numbers is transaction volume. Gross transaction value for the quarter was 975 million, up 16% on the prior quarter and up 39% on the same quarter last year. Volume is the engine as it compounds, revenue and margin follow. It's also worth being really clear about who we win. Our target customer is the mid-market, medium-sized merchants, corporate groups, software platforms, and other fintechs. These entities want an engagement around payments, local accessibility, tailored design and advice, and a relationship built on trust. That is deliberately the segment that global payments giants find hard to serve. And these customers are not motivated by price alone. It's a big segment, it's underserved, and it suits exactly what we're good at. To continue to press this advantage, we've recently appointed a new commercial leader for the Australasian business, focused on new customer acquisition, accelerating our acquiring business, and relaunching business-to-business cross-border services on improved platform functionality. I want to provide a recent live example to make the targeted growth model concrete, the University of New South Wales. Our journey ran through 6 stages. First, we embedded our capability in Nelnet Zeta's enterprise software platform. That enabled an introduction to UNSW, where Asian wallets were then pitched for international tuition payments. We signed a commercial agreement, completed a technical integration onto the university's payment pages and finance systems, and went live with Alipay on tuition flows in October of 2025. We're now in stage 6, extending the same integration to WeChat Pay, giving students a second payment wallet option and limited incremental overhead on both sides of the relationship. Why does this work? Well, for international students and their families, they pay directly via the mobile app they use every day. So there's no unfamiliar card entry, no FX friction, and no failed cross-border payments. For UNSW, it's fewer failed payments, faster receipting, and a much better student experience. And for Novatti, it's a percentage of every settled transaction. The result, since the October launch, more than 60 million of gross transaction value processed, growing quarter on quarter, and more than 0.9 million in revenue to Novatti. That's what one customer can contribute once fully deployed and adoption starts to compound. And a key point to focus on, UNSW is the first Australian university to deploy this integration with Novatti. Through the embedded distribution channel, more than 30 additional tertiary institutions can implement the same solution via the Zeta API. One working customer, a validated distribution model, and a scalable channel to repeat it. So that same arc, convert, sign, integrate, launch, and drive adoption, is now running across a pipeline of new customers spanning every key product line in our Australasian payments infrastructure. For example, in issuing, we're working with Vivi Money, a new AI-powered spend platform, to issue globally accepted Visa debit cards under our Visa Principal membership. We've also signed a rewards card program where our issuing stack runs the program end-to-end, as sponsor, processor, ledger, and settlement. In merchant acceptance, an airport retail chain across Australian airports is adding Asian wallet acceptance, capturing spend at one of the highest converting touchpoints there is. Also, an Australian subsidiary of a major Asian fintech will distribute our card-present terminals and our e-commerce acquiring. and we're embedding real-time account-to-account payments into a local subscription platform's product suite. Actually, a little more on that last customer. The RBA's review of merchant card payment costs and surcharging is changing how merchants think about payment acceptance. As we previously announced, we expect no material impact on our existing card acquiring book, but the RBA review has generated a strong line of inbound interest from merchants testing the market for non-bank payment options. Now, our expanding account-to-account product suite gives customers an alternative or a complement to card payments. So this is a regulatory change working in our favour. The common thread around all these opportunities, they run on Novatti's own payment rails, and revenue is driven by end-user adoption after go-live. It's the UNSW curve repeated. So where does this go from here? When I arrived in early FY24, we set out a three-phase roadmap with a promise of discipline and a simple rule that each phase must be earned before the next begins. That's the execution discipline I've set as our internal bar. Phase one was about clarity and simplicity. Reset the strategy, streamline the business, address the P&L, and get to operating cash positive. We took $10 million of cost out of the business. We divested non-core assets, including the International Bank of Australia and Immersion, and we exited several low-margin revenue streams. And we delivered 4 quarters of positive normalised operating cash flow. Everything on that list was a commitment before it was a result. So phase 2 commences in FY27, and it has 4 parts. Scale the AUNZ payments business with the same discipline, with growth that supports margin, not growth at any price. Reinvest into the core business to improve the flywheel, continuing the work you saw in this quarter's numbers. Deepen our connectivity and leverage into the emerging digital payment rails we covered at the start. And examine a targeted and EBITDA accretive acquisition, deliberately modest in scale, to prove the playbook and integration discipline before we go further. Then phase 3 is acceleration, organic and inorganic growth on top of a proven engine. The destination is local leadership in hybrids payment infrastructure, traditional and digital rails working together, focused on emerging and underserved segments, with customer relationships deep enough that Novatti effectively operates as their commercial operating system. Along the way, incremental progress towards our 70% gross margin target and risk management as a core capability at scale. Payments is a highly fragmented industry ripe for consolidation. M&A activity within the Australian payments market is already underway and will accelerate as the Treasury reforms to an activity-based payments licensing framework roll out over the next 12 to 18 months. Many smaller or privately held PSPs will choose to opt out of the required uplifts and investment across product, compliance and governance. So potential M&A is a key focus area for me this year. In summary here, we're now at phase 1 complete, phase 2 is commencing, and phase 3 unlocks only when phase 2 is delivered. That sequencing is deliberate. It's how we've rebuilt credibility over the past 3 years, and it's how we intend to keep it. So let me close where I started with the 3 things I want you to take away. In summary, the turnaround is complete. 4 quarters of normalised positive cash flow and 50% group margins say that credibly. Our core business is growing profitably with a proven, repeatable customer model behind it. And the road ahead is staged, disciplined, and pointed at where payments are going, with phase 2 beginning now. To all our shareholders, thank you. The last few years have asked a lot of your patience. Our job now is to convert that foundation that we've built into growth and shareholder value, and that's exactly what FY27 is for. Thank you also to the Novatti team, whose hard work sits behind every number you've seen today. And with that, Beth, let's take some questions.
Thank you very much, Mark. Thank you for your presentation. We have got a number of questions. I'll start with the first one. The share price has fallen heavily over the past few years. Why should investors believe FY27 should be any different?
Why different? Well, because the big questions that investors were asking of me 1 year ago and 2 years ago, like, can this company grow after removing such a large chunk of the cost base? Can it get to positive cash flow? We now have evidence behind it, not just promises. 4 consecutive quarters have normalised positive operating cash flow. Group margins doubled from 26 to 50%, and EBITDA from the core engine is also nearly doubling in the June quarter. We can't control fintech sentiment, and I won't predict the share price, but what we can control is execution. And our record over the last 3 years is that we deliver what we commit to. As I mentioned, the digital economy brings incredible new dynamism and opportunity to payments. We have an exciting vision for the company and its place in that world, and FY27 is about continuing to execute in growth mode.
Thank you. Another question here is, you call it positive cash flow, but the 4C shows an operating outflow of 1.8 million. What's the reality?
Yeah, look, this is important, so it's worthwhile stepping into this again. Both numbers are real, but the difference between them matters. Again, the headline 4C number includes payments we made against historic liabilities, legacy debt, and older creditor obligations built up in prior years. These are payments made against the past, against the legacy company structure, strategy, and operations, not the cost of running today's business. Exclude those, and the business generated 0.3 million in cash in the quarter, the 4th consecutive quarter that has been positive on that basis. And I'll add that every business line in the company across the group now generates positive direct EBITDA, which is a dramatically different position to the business that I inherited. We defined the normalisation in the footnotes to all the reports. They can track it quarter to quarter because that's what we can control.
Thank you. This question actually leads on from that. How much historic liability remains and when will it be cleared?
So the creditor group we're referencing are all being managed very strategically. Historically, the largest and the most important is the ATO, the Tax Office, Australian Tax Office, and the legacy debt here has reduced from what was over $5 million at its peak to circa $1.3 million today, and the final debt payment to the ATO is scheduled for April of next year. And I'll add just for completeness that we're up to date with all ongoing forms of tax obligation at this point. The key point here really is trajectory. We're using the improving profitability to work these balances down deliberately quarter on quarter, and this quarter's outflow shows real progress. With our pivoted growth and the phase 2 roadmap I walked through, you should expect continued progress for FY27 in this area.
Thank you. Cash, is at 3 million. Will you need to raise capital? Should investors expect dilution?
Yes, the cash is 3 million at the quarter end, plus the 1.2 million from the AUDC share sale that was settled and received in early July. More important, though, is the direction of travel. The underlying business, again, is now cash generating, which is a fundamentally different position to 12 months ago, 18 months ago. That growth generates cash, and that cash funds more growth. Effectively, the flywheel is turning in the right direction. We also hold real value in assets like our remaining AUDC stake, which gives us options without touching your register. Our phase 2 roadmap prioritises our structural improvement, but I won't comment on any future or potential scenarios at this point.
Thank you. There is a question about AUDC. Why sell AUDC shares if it's so valuable? And then another question is, what is the remaining stake actually worth?
So the sale did a couple of things for us at once. It obviously realised 1.2 million of value that we created by incubating AUDC. And it also attached a tangible anchor from the transaction price, 80 cents a share, for the 18.5 million shares that we still retain. We only sold a small portion, it's about 7% of our holding, and we directed the proceeds into growing our Australasian payments business. AUDC itself is scaling. There's a bunch of new senior hires. They're launching a New Zealand dollar stable coin. They're now opening up Southeast Asian corridors, and we're progressing joint customer projects together now. So I'd characterise the recent sale more as a trimming rather than exit. We still remain a substantial shareholder with exposure to significant future upside.
Thank you. There are a few more questions. Group revenue grew 5% quarter on quarter. That's modest. Where's the growth actually coming from?
So the answer to that is to look one layer down, the AUNZ payments infrastructure business, which is the core of the company and the core and central to our strategy. This is the business we're building around. This grew 8% quarter on quarter, gross margin by 26%, and EBITDA 95% quarter on quarter, with the underlying transaction volume up 39% year on year. The group revenue is a blend of that growth engine and the remainder of the streamlined portfolio. And all the leading indicators here sit ahead of that revenue. So we talked through the customers in recent quarters that are moving through that implementation process into processing, and UNSW shows what happens to revenue as our operating models and distribution partners become efficient. To emphasise again, margin quality matters just as much as the revenue headline. We have deliberately undertaken significant and very disciplined revenue reform over the last 18 months to build that 50% gross margin alongside continuing to grow the business.
Thank you. There's a question around bill pay. You've withdrawn bill pay for overseas payers. What's the revenue impact and when does that come back?
Yeah, this is actually quite a complex, there's a complex set of intersecting movements here, but in essence, they're all driven from a regulatory change to anti-money laundering and counter-terrorist financing reform in Australia. We expect the end state here is that we need to establish greater direct control over BPay payer accounts and the flow of funds through our China payments platform. We've actually started that upgrade, and we're also expecting some final implementation guidance from the BPay scheme in August to finalise this set of changes. I'll also add that direct Asian wallet processing for merchant acquiring, like UNSW, is unaffected, and that continues to operate as normal. So when bill pay relaunches, it'll serve a wider set of countries and market wallets than the largely pre-existing Chinese student base it served before. So the product will resurface with a bigger addressable market later in calendar 2026.
Thank you. Phase 2 mentions potential targeted acquisition. How would you fund that without diluting shareholders?
So as I mentioned, any acquisition will be deliberately targeted and deliberately modest. The purpose in phase 2 is to prove our acquisition playbook and integration discipline, not to bet the company. We obviously haven't identified a transaction to announce, so a funding discussion would be premature. What I'd point out again is how we've behaved consistently under my tenure with highly disciplined execution. We've divested non-core assets rather than holding them for optionality. We exited the wholesale cross-border business because it was destroying economic value, and we've sold a portion of AUDC when it made sense. So any acquisition will need to meet the same test. Does it create more shareholder value than any alternatives?
Thank you. One last question. Thank you to all those that have submitted questions. What guidance can you give for FY27? When will you reach the 70% margin target?
The business is not yet mature enough to provide ongoing earnings guidance. What I can give, though, is the shape. The momentum inside the Australasian payments business carrying into FY27, a pipeline of customers moving from implementation through to live processing, and each of the phase 2 priorities that we've laid out very clearly. On margin, we've moved from around 26% to 50% in a year. The path from 50 to 70 will be more incremental through higher margin products gaining share, transaction volumes compounding, and all our internal systems and processes are set up to incentivise gross margin versus revenue, for example, sales commission. So we'll report progress every quarter, and I'd encourage you to simply judge us on the same way we judge ourselves on delivery against what we've said.
Thank you. That answers all the questions that we have. If anybody does have any further questions, feel free to email us at investorrelations@novatti.com. Thank you, everybody, for joining the webinar. That concludes this morning's session. Thank you for your time, Mark, and thank you for those that have joined us. And this investor webinar will be posted onto our website later today. Many thanks all.